And welcome to 2026, everyone. This is the Carson's Take. I was going to say very first of the year. I don't think it's the very first of the year. This is our second of the year, but we're going to discuss our 2026 market outlook, riding the wave. Sonu, we've made it. Last week, we kind of talked about what we learned, so we're not going to talk too much about last year. We did a review last week in our latest Take 5 video. We've been pretty bullish. We've been pretty optimistic. Yeah. What do you think stocks and bonds will do this year?
Yeah, that's our expected return is similar to what we had last year. Last year, we were bullish. Mm-hmm. We expected a 12 to 15% return for stocks. The S&P 500 did 17.9%, including dividends. This year, we are expecting another above average year with 12 to 15% returns for stocks on the back of, fairly strong economy, at least an economy that's growing on trend. Mm-hmm. We have fiscal spending to boost that. We have rate cuts. Don't fight the Fed. We'll talk about that. And we have market momentum. That's the wave. And the icing on the cake, if you want to call it icing, is technological transformation. Mm-hmm. Everything happening with AI, right? Yeah. And on the bonds front, we expect 3 to 5% expected return.
And bonds had a really good year last year. We've talked about this, gained almost 7%, the best year since 2020. So 3 to 5, not quite as good, but we still think equities are the place to be. So I'll talk about equities for a second. Maybe you can talk about the economy. Momentum is a wonderful thing, right? An object in motion stays in motion more often than not, unless something knocks it off. Now, Sonu will talk about maybe some worries, but the reality, everyone, is this bull market, it might feel a little old, but Sonu, we're in the fourth year of this bull market. The last 50 years, bull markets that got to this point, they made it to an average of 8 years. They made it at least 5 years. So momentum is a beautiful thing. And I've talked about these for a long time. The dual tailwinds to a bull market. Keep this real simple, everyone. Earnings and profit margins both continue to move higher, both expected to hit record highs in 2026. Again, reasons to think that stocks will do well. Last comment, your average year gains about, 8, 9, 10% ballpark in there. We think, again, without a recession, we're going to see better than average returns. Yes, we've had 3 great years, but we think 2026 might be the fourth. Sonu, on the economy, you mentioned 3 big drivers. You want to dive into those a little more?
Yeah, look, we came into a year ago this time, everyone was really optimistic. Mm-hmm. We just had 2 consecutive years of near 3% real GDP growth, which means GDP growth after accounting for inflation.
And 25% gains in the stock market back to back. Yeah.
Yes, back to back. Exactly, right? And, when everyone's optimistic, maybe that's some reason for caution. And we talked about, maybe a double-digit drawdown in the first 2 quarters, first half of the year. We got that, right? With Liberation Day and everything. This year, I think the tariff headwind fades, right? We think the Fed will continue cutting interest rates. They already cut 3 times, about 0.75 percentage points over the last 4 months, between September through December. We think that will continue this year, maybe another 2 or 3. And fiscal spending, a lot of tax cuts that were passed by Congress last year actually go into effect they've already gone into effect 7 days ago. We're recording this on January 7th. Right. And so a lot of households will see outsized refunds because a lot of these tax cuts are retroactive to 2025. You have higher deductions for state and local income taxes. Tips can be deducted. Seniors get a higher deduction, things like that. Right. So all of that, these excess refunds, Ryan, where do you think that goes? Probably consumption. Right. That's going to boost the economy. Last year, yes, the economy did slow a little bit. We think that will pick up. There'll be, hiring has been on the weaker side. If you think, okay, what is kind of troubling in the market? That's the labor market. The unemployment rate has gone up to 4.6%, right? A year ago, it was about 4.1, 4.2%. Anytime the unemployment rate goes up, yes, that's a worrying sign. Over the last 6 months, we've had about 3 months with negative payroll growth. Right. So hiring's weak as well. That's a worry. But that's why the Federal Reserve is cutting rates, right, to shore the labor market up. And we think that will, I honestly think hiring will likely pick up this year as some of the uncertainty around tariffs fade away. We get a little more global activities picking up as well. That's a tailwind for U.S. exporters and U.S. multinational companies, which is how they make their profits, right? 40% of revenues for the S&P 500 come from outside the country. And if global activity is picking up, that's a tailwind.
No, so we have monetary policy, We have fiscal policy. We have momentum being led by earnings and profit margins. And then AI. We'll keep this real simple. AI spending continues to soar. That, again, could be a major driver to economic growth as well. Sonu, any other, you mentioned around the globe, we're probably getting near the end, but one of the big themes last year was just how well the rest of the world did. U.S. did great, up 18% total return ballpark. But rest of the globe was up like over 30% if you look at most parts of Europe and different parts of Asia, different areas. Will the rest of the globe keep doing very well, you think, in 2026?
It's always hard to predict over short time frames. Okay, is the US going to outperform or will international stocks outperform? What we recommend is, look, we are in a global bull market.
Yep.
At the end of the day, that's what it is. And we want to be diversified globally. In fact, diversification worked last year.
Oh, yeah.
Right. And we think, that's the name of the game this year as well.
And I'm sure listeners want to hear this one too. Gold, silver, copper, a lot of these commodities did very, very well last year. We manage real money, right? We do have a little bit of gold in some of our models. I think there's some opportunity in these commodities. We're also getting a little geeky looking at managed futures potentially. But do you think it still makes sense to be diversified with diversifiers out there?
Exactly. You want bonds, right? You don't want to throw out bonds.
Right.
And because just in case we have a recession, if you're wrong, we don't think there will be one.
Right.
But bonds will protect the portfolio in that scenario. But we think our base case will be, we'll get growth this year, but it may be inflationary growth. Now, we don't think inflation will go sky high to 4% or anything like that, but it's probably going to stay closer to 3% rather than 2%.
Yep.
In a scenario like that, what do you want? You want other diversifiers, like you said, gold, other commodities, things like that. Things like copper, aluminum are hitting, new record highs. That's a sign that, global activity is picking up and we're getting a little bit of inflationary growth.
Yeah. And, we can go all day on this. And a lot of times we do. But you don't have to own copper. You don't have to own silver. You don't have to own gold. If you own the S&P 500, you own a basket, you own materials, you own some industrials. If you go around the globe, take a look what history says, how emerging markets do when a lot of these, base metals start to do well. Spoiler alert, they do pretty well. So again, you can have some exposure to some of these commodities simply by owning equities as well. Something to definitely think about. I'll put a cherry on top like this. Old saying, everyone, don't fight the Fed. We're in a midterm year. Midterm years haven't been that great lately. 2018, 2022, not good for investors. The Fed was hawkish back then, meaning hiking interest rates kind of slow things down. Where are we now? Sonu just said it. The Fed is cutting. 22 times the Fed is cut with the stock market near an all-time high. They just did it last month. 22 times a year later, the S&P 500 has been higher every single time, up like 14% on average. That's kind of right in the range of what we expect stocks to do in 2026. So don't fight the Fed, ride the wave. It's still a global bull market. Economy looks pretty strong. There are always worries and concerns out there. We will continue to watch them and monitor them and talk about them in this very weekly series we do called Take 5. We appreciate everybody listening. Sonu, let's ride the wave. We'll see you right next week. Take care.